Welcome to Optimal Insights. I'm your host, Jim Glennon, Senior Vice President of Hedging and Trading Operations at Optimal Blue. Our clients and industry partners have long relied on Optimal Blue for trusted insights and commentary, and these podcasts are an evolution of our commitment to keeping the industry informed. Let's dive into today's episode.
Welcome to Optimal Insights, your weekly source for real-time rate data and expert capital markets commentary, brought to you by Optimal Blue. Let's dive in and help you maximize your profitability this week.
Hello and welcome, everybody. Welcome. It is May, which is just wild. I know I say that every month, but kind of letting that sink in. We've got a great show for you today in the interest of making sure you know what to watch, whether you're an originator, a capital markets person, or just someone interested in the mortgage industry and some great market commentary. Keep listening in. We will start today with a market update, of course. It'll be James and I talking about, a little bit of what's going on with the war in Iran, even though that seems to be sort of a weekly cyclical issue that doesn't seem to change very much, although it is continuing to push the, possibly the globe into some sort of recession. So we'll get into a little detail there. And then after that, we will have Mike and Brennan on to give you all a preview of our market advantage report. Lots of great data insights to talk about there. Also, in a couple weeks here, we've got the MBA secondary conference in New York City. So let us know if you'd like to meet up with us there. Hope to see everybody out there. Reach out to your relationship manager or reach out to me or one of my teammates if you want to schedule something with us to sit down and meet if we don't already have something on the books. All right, before we get into market update, just a little bit of high-level data. OBMMI holding in that range between like 6.25, 6.3, 6.4. Not where we'd love it to be, but we have not seen a ton of upward pressure there, so that's a good sign. Part of the reason is the spread between treasuries and mortgages has remained relatively low. So the 10-year still continues to creep up a little bit. We're about close to 4.5 today. Where we usually see it like a 2-point spread there. So we would be 4.5, 6.5 conventional, the conventional still sticking kind of in that 6.25, 6.3 range. So good, a little bit of good news with some of the bad there. And yeah, let's get a market update going here. We'll meet up with James here in a sec and just talk about what's going on with numbers, but also what's going on globally. All right. Welcome, James. How's it going, man? Hope you had a good weekend.
Thank you, Jim. Pretty good. It's, it's always nice to be back around on Monday, isn't it?
Yeah, why not? Kind of getting right back into the swing of things. I mean, it's got to be better than moving, which is what you've been doing the past couple weekends. I feel like there's nothing worse, man. Like as far as activities go, I can't get fired up for moving. It's exciting, to move into a new place, but just the packing and the unpacking is just dreadful for me.
I have a little fun for 5 minutes with, playing Tetris with the back of a moving truck. And then you hit the 6th minute and you're like, yeah, this is actually a nightmare. And it's going to go on for hours.
Oh, man. Well, sounds like you're on the downhill side, almost complete.
Way more than halfway. So we're cleaning up.
That's excellent. All right. We'll give you a little bit of a reprieve from that and talk a little bit about what's going on in the world before we get to the market advantage segment here. So let's just talk current events first, because I feel like we should always be giving an update on what's going on in the Middle East. Even though it feels like Groundhog Day every Monday morning, we're still not sure who controls the Strait of Hormuz. Oil's up again this week, which is not surprising. There's more escalation. There's more kind of conflicting news between the White House and the Iranians as far as who's in charge, who's signing off on what. So anyway, it's just kind of still chaos on the other side of the planet. There is still this energy crisis that I feel like we in the U.S. are somewhat insulated from. You and I were just talking about how there's different kind of fuel, obviously. Like we have a lot of natural gas here, so not a big issue there. We also produce oil here, but we're not totally self-contained. Like there's always this graph you can go look at online that'll say we're energy independent, right? But we're not truly energy independent. We are sort of energy, like we are net exporters of energy, put it that way. But we still import a ton of things like jet fuel, you were pointing out, right? We don't refine a ton of jet fuel here, even though we might produce the oil that comes out of the ground that eventually goes into that fuel. Some of that is done on the other side of the planet in the Middle East where you currently cannot get to. So there's this, would you call it kind of a COVID style, what did they call it? A supply chain disruption has been in the works for the last 2 months, right?
So I would phrase it, maybe this is a sour way to put it, right? But the United States would like for oil to be flowing through the Strait of Hormuz. If we perfectly controlled the strait and it was absolutely safe, oil would be flowing through. It's not. So who controls it? That would tell me not us, right? We might have more and better military hardware there, but it's not. Insurance companies, the lives of the people in general, the tanker companies themselves do not feel comfortable sending things through, so it's not going through. A large majority of the world's jet fuel is actually refined over in the UAE and Saudi Arabia. So while we might be pulling it out of the ground here, it gets sent over to Saudi Arabia to get refined, and then it comes back around. That's why you've been seeing things like flights getting more expensive. Within that, Spirit Airlines pulling the plug on themselves, saying, hey, we can't do this anymore. So interruptions to the economy. America is resilient. We do have a lot of natural gas. We do have a lot of oil. So heating and electricity might not go up too fast as long as you don't live next to a data center. But that doesn't mean jet fuel is not going up. So transportation costs are not going up. So all of the underlying costs are not going up. And the final tip to that is, the United States is insulated, but our largest trading partner in Europe is not. And so if things are bad for them, if you run the store and the economy is not so good for all of your clientele, it's not so good for you.
Yeah, I keep hearing more and more about it. Yet we are seeing record numbers in the stock market every week. I cannot reconcile that. And I think you're starting to see more journalists come out with opinions, or they're interviewing analysts, obviously, that follow these sort of things more globally. And while, as you said, we're very resilient in the U.S., the consumer is still spending. We have, maybe the Y-shaped economy, the K-shaped economy is a good thing in this case, because you have the well-to-do continuing to see their 401ks and their portfolios increase in value. So they're continuing to spend on high-ticket items that keep consumer spending numbers up. But to your point, Europe and Asia are almost, are all of our top trade partners in the kind of the first and second world are hurting badly from some of this disruption. And to me, jet fuel is just the tip of the iceberg. And I think you alluded to that that's like the first direct cost. Like jets need fuel to run. Spirit Airlines partially went out of business. I mean, I don't know that they were very well off to begin with, but a sudden spike in jet fuel prices that they did not hedge against meant that the tickets that they've sold for the next 6 months and the flights that have already taken off in March and April, they were probably underwater on those or close to it. You're going to start seeing that bleed through to other parts of the economy. It has to. Everything has to get from point A to point B for somebody to buy it. And I feel like we've yet to see the impact of that across all types of other items, just like we did back during the COVID supply disruptions. It's like right now, maybe companies are eating some of that cost, but eventually they're going to have to pass it through in the way of profit margin down to us, as consumers.
And yeah, exactly as you're saying with COVID, like back during the COVID supply shocks, right? We shut down the entire world, but we didn't shut down essential workers and services, right? And oil was one of those. If you worked on the oil rig, you kept working. And if you were a truck driver or a tanker operator, you kept going. You kept the world economy moving. Right now, that is, the gears are stopped or slowed there. So it's not just, hey, it's kind of like COVID, the economy is just in a weird shape. It's no, the main lubricant is held up.
Right, so to speak. Yeah. We've I think over the past 100+ years, we have deemed oil to be an essential resource for everything from our military to transportation to people. So during COVID, as you said, that was one of the things that didn't stop moving, yet we still saw inflation close to 10% during those supply chain disruptions and the extra liquidity and all that. But now we're saying, one of the reasons potentially that we are engaged in a conflict in the Middle East is because we were looking to better secure supply of oil. But in doing that, in trying to reach that objective, we've essentially shut off 20 to 30% of the oil that flows across the world. And that's not something we can just turn back on a dime if and when we resolve this conflict, right? So feels like the stock market's shrugging this one off and maybe shouldn't be, but I've been surprised before just by the sort of anti-gravity nature of the equity markets. We seem to be just looking way past this and thinking that we're going to be better off for it. So anyway, more to come there, but it does feel like there's probably some pain, at least globally, in terms of a possible recession. And I think if we were living in Europe or Asia, we'd probably be feeling that already, but it's yet to make its way, across the ocean. All right, maybe off of that seemingly dark topic, getting into some more current numbers. So last week, probably Chairman Powell's final FOMC decision, final press conference. The Kevin Warsh confirmation seems to be going through just fine, although there's lots of questions there that we will likely help everybody answer over these coming months in terms of some of his testimony. But just getting to the FOMC decision, nothing big there, right? We had no cut, no increase. We had a pause and a little bit of questionable language, though, I think that led to some disagreement amongst the Fed.
The two interesting parts are, definitely first, as you alluded to, it was Powell's last meeting as the chair. So it was, the hang on there was whether or not he was going to continue at the Fed, see the rest of his tenure out, or whether he was going to leave. He's chosen to stay. He effectively stated that he felt the pressure the administration had put on him over the past year was it was really a phantom, something that they couldn't, really work past. And the only way for him to get through that menace was to see the rest of his term through. So he'll be sitting in for a couple more months. No longer the Fed chair, as Walsh should have made it through. There are some questions in the confirmation hearings around how he feels about Fed independence, which we'll be talking. I will also say during the minutes, there was some dissents. Mirren dissented as he did want to cut. There were 3 other dissents saying, we don't like the language in our announcement, effectively hinting that next time will be a cut. They wanted to strip that out, say, hey, we are very unsure, or we're pretty sure we're going to be staying. That pushed future projections to be flat for the rest of the year. And I actually see about a 25% chance for the CME of a rate hike come December. But that's pretty far out. So you always take, 6 to 7 months out with a grain of salt.
Yeah, obviously a lot can happen. And, just based on our conversation a few minutes ago, it does feel a little, premature, a little bit maybe unwise to hint that we're going to see rate cuts in the next meeting when it seems likely that we've only seen the first shoots of inflation that are just going to get worse if we don't see an end to this, this war in Iran. So
with that, last week also PCE came out. It came out at about 3.5% year over year, 3.2% core. It's important for a couple of reasons. PCE is, of course, the Fed's preferred measure of inflation. So this is what they're looking at, the target being 2%. We've been saying 2.7, 2.8, that's a little high, but maybe it's a new normal. 3.5 is decently high. That's not where you want it. You don't want it at 3. You don't want it above 3. So last time around, last month, it was 2.8. So it's a 0.7% increase. The second reason that this is actually a notable number is because if you look at core, which is energy and food prices stripped out, so we're ignoring the fact that gas has gone up, which most Americans would say is a price they're not ignoring right now. But if you strip that out, that's goods and services that have still increased by about 0.4% since last month. So that is it's a hit. That matters. It's going to show up in people's wallets. And again, it's stripping out oil and gas. So if you look at gas prices nationally right now, it's basically $4.50 for a gallon of gas. It's $110 per barrel. for Brent as of time of recording. And the CEO of Exxon was out here saying, I actually think that we could see that get worse. So, the idea that, we're going to kind of coast through inflation, it's not that bad right now. This is the first number showing, it is not where we want it. I don't see a rate cut coming with it. And it's going to be a minute.
Yeah. I mean, the Fed is still taking, still taking criticism for using the word transitory when we last saw a bout of inflation that some would argue isn't even over yet. And now we're seeing it start to bounce up closer to 4%. Again, just seems unwise for the Fed to kind of almost ignore that and say, yeah, we're thinking about the next move being cuts because we see more weakness in the jobs market than we see risks to inflation. And some of that just feels like, you hear that from CEOs of banks and you hear it from analysts right now that this is going to be short-lived, and once the war's over, we're going to be back to normal. But then you read in other areas that high oil is here to stay for a very long period of time for other reasons, not the least of which is the supply chain disruption right now. So I don't know. My take, I'm usually the optimist, but my take on this is it does feel like we're being a little dismissive of some of the risks out there because we feel like everything's cool back here stateside while the rest of the world is suffering pretty bad, and we kind of need them with a lot of, we're still a very global economy despite the changes that have been made by the administration.
Yeah. And exactly as you're saying, right? The hope is that this is a one-time shock that, now gas costs $4.50 and it'll just stay there. There's no cap. There's no deal that's the case. If this continues, gas could get more expensive and everything else will inflate as well. So it's not, if it's a one-time shock, it's almost certainly not done yet. So
yes,
that implies it's going to keep trending.
Yeah. And you've pointed out fuel prices always go up much faster than they come down. So even if they are destined to come down, it took 2 months to get where we are here. It could take 9 months to get back to where we were if we ever see that, or the gas companies see the margins sustaining themselves and we just come out of this with just fuel that costs more because there's more risk there going forward, and that's how it's rationalized in the market. All right, so what else do we have this week? We have jobs.
Yeah, so this week we have the other side of the coin, right? It was all kind of inflation news last week. Now it's jobs. You could hope, hey, well, if there's a little bit of inflation, there's a little bit more speed of money, a little bit more hiring, perhaps. But it's not, so far, it's not projected as a phenomenal growth. So we'll see, Wednesday, we'll see ADP, which is expected to be around 100K. ADP, of course, is a private payrolls. So it's not as robust as the government's is. It tends to be a lot more volatile, but it's always just a good number to get you kind of a inkling of what's coming. On Thursday, we'll have the weekly joblessness claims. They're expected to increase to 205K. That's about where they've been sitting. It's not much of a increase, decrease. That's what we've been seeing. And then on Friday, we'll have the U.S. employment report. Unfortunately, the speculation on it is that it's going to be 53K, it's a pretty anemic number. It's not
essentially zero. Yeah.
Yeah. It's not where we want to see it. The number 2 is the unemployment rate. It's currently at 4.3%. It's projected to stay at 4.3%. I think if we see 53 or lower, that will creep to 4.4.
Mm-hmm. Really interesting numbers and increasingly hard to decipher because of the relatively major changes that have happened in the labor market the past couple of years. But yeah, as you said, anemic numbers, yet relatively healthy unemployment rate because this economy right now doesn't need to create a ton of jobs to keep everyone employed. And that Thursday number, so the initial claims number, that I think last week that number hit a low for the past 30 years or something, right? Barely, but to get below 200K on initial claims is pretty exceptional. And it's a relatively reliable number because it's basically how many people have applied for unemployment benefits, right? So it's not a survey like the BLS report, but it's something that is an indicator of the jobs market and seems to indicate really good health in the jobs market versus when it gets up closer to 250, 300,000, then that's when you see you're feeling layoffs. You're feeling people that are having difficulty finding a new job after they've lost theirs. Anyway, that's a fun number to keep an eye on because it is real time. It is weekly, and it broke a record, or at least came close to a record last week.
But it's definitely, jobs wise, this is the week to be watching. That gets us the two halves of the Fed's mandate. So that kind of, wraps all this together with the Fed, inflation, and jobs. Not too many other critically important releases this week. The final point I have is the OBM MMI sitting around 6.3% this morning.
Yeah, that spread is hanging in there pretty low, which is good. At one point, we were seeing the OBMMI, closer to 2% above treasuries, but now we're more like 1.8, 1.85. So the 10 years closing in on 4.5, but we're still seeing like low sixes with 30-year conventional. So that's pretty healthy. So yeah, we'll see what happens on Friday. Again, you've got the Fed saying they feel like there are weaknesses in the job market that are sort of latent at this point. I guess you can't see them in the numbers, and everybody kind of feels that, but yet the numbers seem to show health there. So this whole idea that we could see a cut the rest of the year doesn't seem to be where the money is pointing, but it's where the Fed is placing their language, which to me means they're placing some of their bets in that category. Anyway, time will tell. All right, James, I think that covers everything for this week. We will now check in with Mike and Brennan. We're going to see what's happening with Market Advantage. So as you know, we now once a month, we have the Market Advantage kind of preview, right? The report has not come out yet. It'll come out next week, but we choose some data from that publication, that report, and we discuss it live on the podcast. So let's hand it over to Mike and Brennan and see what observations they have about market data this week.
Good deal. Thank you, Jim.
All right. Thanks, James.
Welcome to the latest edition of the Market Advantage podcast for Optimal Blue. We're going to be diving into all of the data that Optimal Blue produces for the month of April. It's been an interesting month just with the gyrations in the rate market. Brennan, why don't you tell us about some of the comings and goings from the data perspective?
Yeah, interesting is maybe a generous term. But so obviously the market was impacted, the origination market impacted by a tougher rate environment, to sort of distill it down into the punchline. April lock activity pulled back following a very strong first quarter. Total lock volume was down 9% month over month, but I think still some strong signals when you look at the year over year metrics. We were up roughly 11% year over year. So continued improvement over 2025, despite some of the headwinds in the rate market here to kick off Q2. Purchase activity remained relatively resilient, which I think is really a welcome sign that that's a market that, for a variety of reasons, we've all been keeping close tabs on with the lock-in effect, just wanting to see sort of a return to pre-COVID levels, at least sort of at the median here. So the purchase lock volume declined just 2% month over month, but was actually up 9% year over year. So pleased to see that. Refi activity moderated as you'd expect. So rate term volume down 38% month over month. Cash out declined 12% month over month, but both were still up on a year over year basis, 22% for rate term and 11% for cash outs, up year over year. Refi share slipped to 23%, so under a quarter of total volume. I think that is really just a reflection of the refi market reacting, and then the sort of stability that we're seeing in the purchase market here as we move into the spring buying season. On the rate side, higher for the vast majority of the month than we had been in the previous couple of months. We technically finished the month down if you just look at sort of where things finished March and at the end of April. So the OBMMI 30-year conforming rate, again, the benchmark for the CME futures contract, finished the month at 6.31%. That was down 4 bips month over month, but up 25 basis points from where it had been 90 days earlier. And then jumbo rates ended the month at 6.43, FHA 6.06, and VA still below 6% at 5.9%. The 10-year was up to 440, 10 basis point climb month over month, but the 10-year to 30-year spread, 30-year mortgage rate, narrowed to 190 basis points. So we did get some relief in terms of the TBAs outperforming treasuries in April. ARM utilization came down a little bit, had been 11, 12% down to just above 10%, but I still think you see folks opting for adjustable rate mortgages here, particularly at the higher loan volume cohort in the market. Product mix shift, the big note here is conforming volumes fell below 50%. So they've been hovering just above 51, 52%, but actually into the 49 here, 49 handle for the first time since we've been tracking it. So I think you do just see this continued movement both towards kind of like the non-QM, non-conforming production, as well as movement towards Govy products, which might be a little bit more affordable right now for first-time home buyers. It is interesting because we talk about how the conforming loan limit has just continued to increase, but despite that, you see this sort of trend away from the agency eligible lending. So we'll see how that continues, but sub 50%, that's certainly something of note. Non-QM lending, as I mentioned, stable part of the market here, hanging out in the 8-9% range. No real change month over month, but again, I think if you look at where it was last year, we're still up a couple points above where it was in 2025. And let's see, other points worth noting. I'd say affordability metrics. So despite the tougher rate environment, affordability metrics didn't really change much. The DTIs across all loan products were pretty consistent from March to April. So I think you probably just had folks who were maybe in a position where they would have been more impacted by the rise in rates, probably just not moving and taking out loans in April. I think that's it for the origination side, but probably kick it over to you. I know we had some interesting observations on the secondary side. What did you see in April, Mike?
Thanks, Brennan. Yeah, one of the things that stuck out this last month was the environment kind of in general seemed to be a little bit more positive on the capital market side. So first, we saw generally the best effort mandatory spread increase for conventional product, up about 3 to 4 basis points on average for the conventional 30 and the 15-year. Govy 30 was down. And so how I think about this is that's like the extra incentive that lenders get to hedge and manage the interest rate risk until the point of funding, right? Conversely, with best efforts, that interest rate risk goes to the person you lock that loan with. And maybe with some of the volatility that we're seeing, we might see that spread widen a little bit, right? As the larger lenders and aggregators want to be a little bit more defensive, given as you move between different rate environments, your hedge cost is gonna go up a little bit. So, but it's a positive for folks who have who are using our software products or our services as that spread increases. Another interesting trend was past couple months we've seen loans sold to the cash window gain more and more share of our loan sales. And this month we saw it kind of bounce back to the MBS securitization outlet. So that went up almost about 3 points from going from 41 to 44% of where we see loans sold on a monthly basis. The kind of leading theory right now is, you could see, as we saw rates rise, servicing values increase. And if you want to actually retain that loan yourself, instead of selling that loan to a larger lender or an aggregator, the economics might have made more sense. And then, we mentioned, home prices going up. We mentioned the conforming limit going up. We've seen more and more specified pool stories start to build up as well, which could also be feeding into the shift back to MBS as lenders start to look at these newer specified stories or any type of like pooling strategies. The economics could just make more sense now for that. And we saw very stable numbers across where folks are selling their loans. We saw just a minor change between people selling into the third and then the fourth or lower cohort, but not really much to change there. The other two pieces that I want to call out, MSRs increased in value this month, which makes sense. On average, it wasn't up and down month, but on average, rates were up over the course of the last 30 days. And with that, we saw servicing hit like an interesting mark for us where it was above a 5 multiple. So it was up 5 basis points to a 1.29 price. And so that 5 multiple is a really interesting spot because, back before COVID, like the common servicing multiple was a 4. And then as we saw appetite for servicing rights change throughout the course of COVID, and we've seen folks invest more in recapture and retention strategies, we've seen that value drift even higher. Well, you'll see trades done in the 6 or a little bit above a 6 multiple, but to see new originations at that 5+ multiple is interesting for a variety of reasons. I think recapture is a big part of it, that continued importance on owning that borrower relationship. And you've seen it in some of the M&A news in the industry as well. Everyone is valuing that at a very material level. So that's something to be watching. And then this last one, it kind of goes in potentially the same vein here, is we saw our investor count increase this month. So this stat tracks the average amount of investors who actually bid on a loan sale when our lenders are selling loans. And so, this was at 14 for the last 3 months, and it just bumped to 15 this last month, which means there's some additional folks coming into the market, or maybe just being more aggressive and bidding on more loans that we're seeing in the system right now. Which I think all these signs kind of point to like a little more of a positive spin on the capital market side, where I think the takeaway is when there is some of this volatility, there's also opportunity. It's not always bad when there's volatility. There's more work, potentially more thought exercises you have to do. But in general, there's also opportunity there, which I think is kind of like my larger theme for the last month.
That's great. Yeah, I feel like that theme carried across both the capital markets and the origination side, just despite a tougher rate environment. And we're hearing it from clients, right? It seems like folks are taking the rate headwinds in stride, and folks have some optimism here, and looking forward to seeing everyone here at MBA Secondary in just a few weeks.
Yeah, excited for MBA Secondary. I'm excited to get the pulse on the ground there. It'll be interesting. I think even with some of these rate moves, there's been so many head fakes and up and down movements the last 4 years. I think generally the industry is like prepared for this now. Whereas I don't know if I would say the same thing in like 22. So I think it's hardened the industry in a positive way. These like kind of rate moves that we've seen, and some of the other larger industry trends with consolidation and things like that. But looking forward to seeing everybody at the secondary, and we'll be back next month.
Thanks all.
All right. Great podcast again today, as usual. Let's close this thing out. Thanks so much, James. Thank you, Mike and Brennan, for the update. That's it for today. Join us next week for another episode of Optimal Insights, where we'll continue to provide you with the latest market analysis and insights to help you stay ahead. Check out our full videos on YouTube. You can also find each episode on all major podcast platforms. Thanks again for tuning into Optimal Insights.